Well, sticking with results, high municipal expenses, increased net finance costs and prior disposals have contributed to a decline in Dipula's distributable earnings. The group, however, anticipates that favorable macroeconomic indicators will translate into positive developments in the property market in the short to medium term. Dipula CEO Izak Peterson joins us with more insight into the company's performance. Thank you so much for your time, Izak. Let's actually start off there with the top line because we did see a climb of 7% there. What can you attribute that to?
Thank you very much, and good afternoon to the viewers and yourself. We did some really good leasing on the portfolio this time around. Then we go through carefully through the results. You will notice that we had let about 240,000 square meters through the portfolio. I mean, our portfolio size is roughly 900,000 square meters, so we did about 240 square meters of leasing. That's a total value of about 1.4 billion over the lease term. Those leases were done at very decent rates on the renewals and the new lease side of things. Main contributor to positivity was our retail portfolio by far. Excellent performance from the retail portfolio. We had renewed government leases, at a significant discount to last year, and the main reason for that is that these leases had actually escalated themselves into out-of-market levels, but that correction happened. And if you look at the guidance that we give into market, I think with that scenario sort of normalizing and costs coming down going forward, with inflation normalizing and basically a favorable interest rate environment, the correction is going to be very positive for Dipula, and we anticipate a much better performance for next year. But I mean, we are pleased with the results. 7% top line growth, net property income up by 2%, and basically our property valuations were up 5%. Our NAV, which is also quite a key indicator, was up about 5%. And at the same time, you'll see that our balance sheet is very strong. Gearing is at only about 35%, and our cover ratio is close to 3%. Interest cover ratio is close to 3%. So we are pleased with this. I think it hasn't been the easiest trading environment.
Yeah.
But having said that, things are definitely turning for the better, and we're sensing a lot more positivity out in the market at the moment.
Well, let's talk about a cost, because you did see an escalation there in a cost creep. What were the major pressure points there, and is it part of the uncontrollables?
Well, there's a few things. I think municipal costs, particularly electricity, did go up, but quite steeply. Of course, we do recover most of that from our tenants, but where we've got vacancies, we obviously can't recover that. So that cost does filter through to our cost line. And in addition to that, you would know, I mean, we've actually indicated in our press release that our labor component of security and cleaning costs had gone up by quite a steep increase. And I think probably just a correction where, these companies are trying to normalize salaries and all catch up with perhaps increases that were not passed during the COVID pandemic. And that started filtering through there. And it's also a scenario that we foresee sort of normalizing going forward. But you're probably going to see sort of salaries inflation not cooling at the same rate as everything else in the market, because there's some corrections still taking place there.
All right. Well, moving on, I do see that you are experiencing negative reversions, particularly with the portfolio where you have government as your tenant. How are you managing this?
I think we're over the worst there. The government scenario, or the office scenario, is very specific, and it was specific for this year. A bit of context. Since COVID, government has been very slow in renewing leases, so we were running those leases on shorter tenures, 1 year at a time. And obviously we kept the rentals at those levels and/or sort of increased them in line with inflation. But of course, these leases have been in the system for 10, 15, sometimes 20 years and escalating at fairly high escalation. So that correction there was basically just to reset those rentals back to market. So we are back at market now. We've signed leases of 5 years and longer. So that scenario there should actually get us back into a situation where the in-portfolio escalation of roughly 7% starts filtering through to investors.
I mean, Izak, there is a narrative of you feeling rather positive about the future prospects of the economy and also for Dipula. I mean, with the GNU in place, do you expect a significant change in the market dynamics for the property sector?
I think there's definitely a sense of stability. I think last year, this time, if I was sitting here talking to you, we'd have been talking about how uncertain the future was because we didn't know what's going to happen in the elections. It was also, this year is also a year with lots of elections in trading partners. I mean, we've just seen the United States election come and go. That was peaceful. Whatever's going to unfold there, we're yet to see. But I mean, I think that's a very sophisticated economy. And I think even if there are controversial policies that might be introduced there, I mean, those will take time to actually filter through to the market. But where the momentum is building, and positively so, is that global interest rates are coming down, inflation is in check, and basically in South Africa, we're feeling positive that the government of national unity is actually working. I mean, I think you'll see from time to time individuals complaining about the government of national unity, but generally speaking, at government level, it looks like the guys are doing the right things there. We've seen stability in the electricity grid since the appointment of the new minister there. It looks like the portfolios were actually put in place, putting the right leadership in place. I mean, often our issues in South Africa are not related to a lack of resources, but more so to the management of those resources. So we're very positive that the private sector is sort of blasting ahead, trying to, work with a situation that we dealt. But I mean, there's a global positivity that's sweeping through the markets, and you can see. I mean, if you look at the property sector alone, past 12 months up 50%. On the listed side of things. So that positivity in the listed markets should start filtering through to the physical property markets as well.
All right. Well, thank you so much for your time and giving us more insights and more detail on the numbers that came out from Dipula. That was Izak Peterson, CEO for Dipula.